Imagine working harder than ever, grinding every day, only to discover that the money you earn isn't actually real. What you call money, what you save, what you owe, it's largely a fiction. Banks, hidden behind glass towers, are inventing money out of thin air, profiting from your labor while most people remain blind to the system controlling them. For centuries, a select few have understood the secret of money and used it to become unimaginably wealthy while the rest of the world struggles. To understand how banks create money, we must first go back in time, farther than most people realize. Money wasn't always paper bills or digital balances. It began as something tangible: gold, silver, even grain. Currency once had intrinsic value, scarce, measurable, and real. But scarcity has limits. Governments wanted more, wars demanded more. Trade expanded beyond the capacity of coins. This is where banks stepped in, and here's the first twist. Banks didn't just safeguard money, they invented it. In 15th century Florence, the Medici family pioneered the concept of fractional banking, lending more than they actually held. If a merchant deposited 100 florins, the bank could lend 90 florins to someone else while still keeping the account active. On paper, the bank's balance sheet multiplied money. Over time, this idea evolved into the complex system that dominates today's global economy. Early European bankers like Johann Berenberg became the architects of what we now call money creation. They didn't just store wealth, they manufactured it, legally, invisibly, and profitably. Fast forward to the 17th century. The Bank of England is born. Money is no longer just gold, it's promises, credit, and trust. The government, desperate to fund wars and infrastructure, allows the bank to issue notes backed not by full gold reserves, but by government debt. Trust itself became the new gold. Governments, supposed guardians of the people's wealth, handed control of money to private institutions. A system meant to serve the public began serving private profit. By the 20th century, fractional-reserve banking had become the foundation of modern finance. Banks could now create money simply by issuing loans. But here's the paradox. The more money banks create, the more debt citizens accumulate. Debt became the engine of the economy and the source of banks' power. Let's break it down. Imagine you need a mortgage. You walk into a bank. The bank approves your loan, and at that exact moment, the money isn't coming from a vault. It's created digitally, on the spot. You now have cash in your account. You spend it. The seller deposits it. The bank uses that deposit to issue even more loans. Money multiplies, not through work, not through savings, but through lending. Citizens work and repay interest on money that never physically existed. Banks profit twice, from the interest they charge and from the economy their loans fuel. And this is why, even as productivity rises, wages stagnate. Even as people work longer hours, they don't grow richer, because money isn't scarce anymore. It's invented, and debt is its price tag. But a system built on invisible money can only stretch so far. History is filled with cracks in the illusion. 1929, the Great Depression. Too much credit, stock markets collapse. 2008, the global financial crisis. Banks gamble with trillions in derivatives, betting against the very loans they issued. Greece, Argentina, Puerto Rico, sovereign debt crises follow the same pattern. Each time the public pays, jobs vanish, savings evaporate, banks are bailed out, rescued with taxpayer money or newly created debt. The system is designed to protect those who create money, not those who earn it. You might think, surely someone tried to fix this? In 1933, the Glass-Steagall Act tried to separate commercial and investment banking. Loopholes destroyed it. In 2008, governments injected trillions through quantitative easing to stabilize markets, but most of it enriched the wealthy. Cryptocurrencies promised decentralized money, free from banks' control. But adoption remains limited and tightly regulated. Every fix fails because the architecture of modern finance is built around one idea: profit from debt. The more sophisticated the fix, the more invisible the mechanism becomes. Now connect history to today. In the US, the average household debt hovers around $160,000. Student loans alone exceed $1.8 trillion. The Federal Reserve's balance sheet has ballooned by over $8 trillion since 2008. People work longer hours, take on more debt, and chase money that doesn't physically exist. Meanwhile, banks grow larger and more profitable than ever. The gap between labor and money creation is not a flaw, it's the system's design. And so the cycle repeats. Crisis, bailout, new debt, crisis again. The system is strong for those who control it, and fragile for those who sustain it. When you strip away the illusion, three truths emerge. Money is not what you think it is. It's created out of debt, not labor. Debt drives the system. Citizens' work funds bank profits. And the system is engineered for the few. Crises always protect institutions, not people. This isn't conspiracy. It's history, law, and economics. If you understand how money is invented, you gain awareness, real power. The world may continue to spin, but understanding the mechanism lets you navigate smarter. Will the system collapse under its contradictions? Maybe. But history shows the powerful adapt first and the workers last. The money in your pocket is a promise, and that promise is fragile. If this video changed how you think about money and power, hit like, subscribe, and share it. Because the more people understand the truth, the closer we come to reclaiming control over a system designed to control us.